Are you saving up a home loan deposit and trying to avoid lender's mortgage insurance? First home buyers, you're going to want to watch this one. Now, first of all, there's some good news. Under the first home loan deposit scheme, the Australian government will guarantee low deposit loans for eligible low and middle income earners who have saved up a deposit as little as 5% of a property's value without having to pay lender's mortgage insurance. If you've seen my other videos on LMI and LVR, this should pique your interest. Now, how do you get your hands on this sweet deal? I'm going to walk you through that. Hi guys, this is Fabian from the Lending Lab, a mortgage and finance broking firm that helps customers reach their goals, take the next step in their financial journey. Before I show you the ropes, it's important to understand this is general information and it's current at today's date. This scheme changes every year and we're not factoring in your individual personal financial circumstances or goals. You should see some professional advice before making any decisions. Right, so as phenomenal as the first home loan deposit scheme sounds, there's a couple of catches that you need to be aware of, so let's not get too excited just yet. Now, I've done a video on this previously, so make sure you check it out, but the deposit isn't your only cost. You do have to factor in purchasing costs such as stamp duty, bank fees, and conveyancing fees. So saving up 5% isn't necessarily going to seal the deal. You'll need to save up some more to prepare for the other bills that are going to be coming your way. Now, keeping that in mind, those costs are different in every state, and in some states you might even qualify for the first homeowners grant, or there might be some stamp duty concessions that waive that cost. The Australian government loves to incentivize new buyers, so take advantage of it. This might mean, depending on which state you're in and your circumstances, you could potentially get away with just having the 5% deposit. Now, that aside, you actually do need to meet some other eligibility criteria. There are some restrictions that have been put in place for this scheme to make sure that the people who need it most get prioritized. But that means that not everyone can qualify. One limitation is going to be your income. If you earn over a certain amount, you'll be ineligible for the program. For example, if you're an individual, you'll have to earn $125,000 or less to qualify. If you're buying as a couple, that amount increases to $200,000. The second thing that will restrict you is the value of the home that you're buying. Most states cap the amount depending on the property type. So for example, the price caps are slightly higher if you're building a property or buying a brand new property. This is because they want to stimulate the construction industry and they're making sure they're putting more properties on the market to help with the growing population. Now, what that means is that there's different schemes. There's one for new properties and there's one for existing properties, and each of them have their own availability. Now, not all banks and lenders are participants of this program, and they all have slightly different processes for reserving a spot. So you're going to need to chat to either a participating lender or mortgage broker to make sure you get your spot reserved. Anyway, I hope this video was helpful for you. I hope you learned something. The way you can show me that you did is by giving me a thumbs up. And if you like what you're hearing, feel free to subscribe. If you have questions, put them below. Be happy to answer them. Thanks. Have a great day.